Good morning, everyone. Welcome to Macro Monday. It's week 21, 22nd of May. This is James Kim. I will be the host for today. Before we get started, a quick disclaimer, just so that everyone knows that we're not here providing you specific investment or trading recommendations. The information that will be on the presentation today should be taken for educational purposes only. Just a quick summary of what we saw last week. We finally had some volatility in the market. We got a midweek surprise as US equity suffered its biggest sell-off this year on the back of news that former FBI Director Comey had put together a memo outlining a conversation with Trump. That led the Dow to lose 372 points. It was a big day. S&P was down to the similar magnitude or the same magnitude, down 1.8%. That was the worst one-day fall for the two indices since September 9. In Europe, we saw a 1.2% in decline. Again, that was its biggest one-day fall since September. Volume was decent. Wednesday marked the third busiest day of the year. Bank stocks, which had been one of the strongest runs since Trump's victory, were among the hardest hit. Obviously, the VIX had jumped quite aggressively over that night, up 46% after printing its lowest level in decades earlier in May. Safe havens such as gold, they enjoyed a big rally. They were up in its largest one-day gain since March 16. The yield on the US 10s fell to 2.216%. That was its biggest one-day drop since June 27. Base metals, however, were generally higher this day and across the week as well. They were quite firm as the weaker USD is supporting investor appetite. Base metals were also firm on signs that the PBOC may pause in its campaign of regulatory tightening. The PBOC injected cash into the market last week, provided more 7-day funds. So just to cover some key price actions, gold last week gained over 2%, which was its largest weekly gain in a month. Copper actually performed better, rising 2.28% for the week, as the drop in the US dollar continues to breathe life into copper and other industrial metals that had dropped for 2 straight weeks. The weekly gains in copper last week was the biggest since March. Early Monday in Asia, we saw some welcome news for the oil markets as Saudi and Russia released a statement saying that they favor prolonging oil output cuts by global producers through the first quarter of 2018. That set a firmer time frame as well for a likely extension of the curbs. Crude prices jumped over 5% for the week. Remember, this week we have OPEC. We'll be running through what to watch for the week ahead shortly. This is a quick snapshot of the performance of some key instruments since Trump, with the US dollar index now negative since that election after rallying above 100. S&P 500 is still up since the election, up 11.3%. I think it's quite interesting to note that the WTI crude is up to the same magnitude, rising broadly in line with US equities. Despite the recent turmoil that we've seen, gold is down 1.5%, so not too much of a change from Trump's election, while silver is down 8.2%. Copper still holding on to a large part of the gains, up 7.5% since Trump's election. The previous week we saw the China's One Belt, One Road Summit, which concluded on Monday. 68 nations and global organizations have signed some cooperation agreements. There were about 1,500 delegates from roughly 130 countries who attended the forum. Now, it wasn't clear how binding these were or how much capital was committed. The week also started with a turning point towards slower growth in China, as we saw a significant deceleration in industrial production to 6.5% versus 7.6%, which was the prior print. Fixed asset investment, or FAI, grew 8.9% in the January to April period, which implies a slowdown to 8.1%. Growth in retail sales weakened slightly to 10.7% from 10.9%. In the UK, headline CPI came in stronger than expected, rising 2.7% year-on-year in April. Core inflation was also stronger than expected, rebounding 2.4% year-on-year from 1.8% in March. US housing starts declines for the fourth month, whilst US industrial production grew at the fastest pace in 3 years during April. Now, no economist was expecting any significant wage growth for Australia in the first quarter of 2017, but it was still discouraging that the 0.5% rise in the wage price index remains, which means that the annual growth stays at the record 1.9% that was recorded towards the end of 2016. Employment in the UK hit a record high in March. Joblessness fell to its lowest level since 1975. The cable last week made new highs for 2017. The cable is now back to September 2016 levels. In Australia, the April jobs report was much stronger than expected, with total employment rising by 37.4 thousand jobs. UK retail sales growth for April printed much stronger than expected, up 2.3%. In a fresh sign of steady job creation, US weekly claims showed the number of Americans applying for the first-time unemployment benefits last week fell for the third consecutive time, 232,000. However, the bounce in the US markets overrode any of these headlines in relation to the weekly unemployment. Over the weekend, we saw the US sealing a multi-billion arms deal with Saudi Arabia. Now, Trump is on his first international trip. He was in Saudi Arabia on Saturday and Sunday, where he sealed his deal, and he's going to be on an international tour for the rest of the week. Looking at the week ahead, this week we'll continue to watch the US political situation, and after last week's appointment of former FBI Director Robert Mueller as special counsel in the Russia probe, traders will be watching for any fresh news surrounding this. Now, Mueller, for those that do not know, has an impressive career history, and if there is anyone that is going to find any dirt or any lies in this probe, it will be Mueller. An announcement late Friday in the US confirmed that former FBI Director James Comey will agree to testify in open session before the Senate Intelligence Committee. However, this will come after Memorial Day. Now, remember, Trump is out on his first international trip. He's currently on a 5-stop marathon trip across the Middle East and Europe. Tonight, we have the Eurogroup meetings where ministers will review the progress on the second review of the Greek program, the economic situation in the Euro area, and will be briefed on post-program surveillance for Spain. We have a large number of speeches this week. We have Debble Tuesday, Brainard Tuesday as well, with Evans. The focus will be on the FOMC minutes Thursday, the OPEC meetings that I briefly touched on earlier today in this presentation, and on Friday we have US core durable goods. Going back to OPEC, the Saudis most likely will lead the cartel in a decision on extending its production cuts. Saudi Arabia has suggested production cuts lasting 9 months instead of 6 months as previously expected. There also was a talk that OPEC is considering expanding the current 1.8 million barrels a day cut, but it's not clear whether there would be any support for that. So eyes will be fixed on the OPEC meeting later on this week. Over to some charts. So the US dollar index continues to experience a sharp fall, with the previous week's settlement coming in below the 50% retracement between the 2016 low to the 2017 highs. And the failure for the US dollar to hold its losses here is a huge negative. The rally we saw off the lows exactly 2 weeks ago proved to be useless, as momentum failed at the uptrend line, which supported the US dollar all throughout 2016 and on one occasion this year. The rejection that we saw here at this trend line, I guess, was a technical giveaway that the uptrend which the US dollar has broadly enjoyed has now been clearly violated. On further selling this week, we have 96.44, or the 61.8% retracement, as next downside level to mark. However, I have more of an interest at 96.11 down to 95.90, or the Trump election lows, as levels to watch for a potential bounce in the US dollar. The euro, on the other hand, unrelentingly pushes higher on the back of the US dollar weakness. All long positions should be on the lookout this week, as the rally in the euro has been aggressive, is currently overbought and comes up to some important levels this week. We have the US election high coming up, which coincides with that US dollar low that I covered in the previous chart. However, another alignment for consideration is that the euro currently trades in an inverse head and shoulder pattern. Not the most perfect one, however, one cannot argue against the reversal pattern. The Macron gap here coincided with not only a break of the 2016-2017 downtrend resistance line. However, this gap here also happened to be the neckline break. To confirm the validity, as we break down the range between the head to the neckline range here applied to the breakout level, we saw first resistance being experienced at the 23.6% extension, followed by 38.2% extension. And this week, that 100% extension of this range here comes in at just above the 113 handle, which interestingly aligns to that US election top we saw in November. So our core focus will be that 113 handle, where we may see potentially some selling in front of there. Despite the political turmoil we saw in the past week, which lifted the market's appetite for safe havens, our Aussie dollar cleared out the week unscathed. The Aussie currently trades within a channel, and Friday's high happened to find resistance at that upper channel trend line, and only a break and settlement of 2 or more occasions above here changes to technical setup. Downside levels for caution are presented at the 74 handle here, followed by 73.28 or the May lows, and on further selling, weakness is indicated to terminate at the 2016 positive trend line, which connects the January lows through to December lows here. Over to equity indices, this is a daily chart of the E-mini futures. Now, from about 3 weeks back on this weekly macro call, I started to highlight the diverging RSI as the S&P continued to hover at its 2017 highs, and the RSI divergence that we saw. Now, in hindsight, this was a clear giveaway of the moves to come. Now, last week we saw the biggest one-day loss for the year, and the huge sell-off we saw had set the stage for buyers to step in and take advantage of the beaten down stocks. The S&P 500 last week was supported at a short-term December to March trendline, and I must highlight that the volume, whilst decent, starts to decline in the past 2 days of the rally when compared to the large volume which accompanied the sell-off on Wednesday. So for now, we treat the 2-day rise in the S&P as a mere retracement, and this declining volume suggests that the rally could potentially mature within days, and unless it can take out this year's highs, I would recommend long-on investors to be cautious. On further selling, this trend line here, again connecting from the December lows through to March, this would be the near-term support. Break below here takes our focus to last week's low here, followed by the March and April double lows at these levels here. Last chart of the day goes to gold, which saw most recent weakness being arrested at the short-term January to March trend line. The rally of this trend line saw gold last week also punching through the 200 DMA. Now, this 200 daily moving average is expected to be the first support for gold this week. However, any settlement below here is expected to drive gold back to the trend line, and a failure for gold to hold above here will complete a negative technical setup, which would be a head and shoulder reversal pattern, and we all know what this means. However, for now, this is a pure theory. It's still early to draw this conclusion. However, a potential development that we shouldn't discount. This brings us to the end of the weekly macro call. There will be a recording available. Wishing everyone a profitable and a safe trading week ahead. Thank you.